Welcome back to the Brent Bruce Daily. Today is December the 16th, 2022. It is now 2:42 p.m. Central Time, coming to the end of an action-packed week with the CPI report and the announcement from the Federal Reserve. The market is pretty calm right now. I'm going to show you some charts of where we are, but I'm also going to take a moment and show you a 2-year chart to give you some perspective on where we are. And also, we have a big report coming out next week, which is the PCE, which I believe is on the 23rd. So the personal consumption expenditure, which if you follow along, you know that the PCE is the Federal Reserve's number one favorite measure of inflation. And that is the report that they're using to try to get inflation down to the number of 2.0 on the core. So it is a big report coming out next week. So let's jump into the charts right quick here. I'll show you the interest rates and we will get out of here. So right now we're down 6 basis points on the mortgage-backed security, which is quite a bit better than we were earlier in the day. It's been fighting back all day here. And again, you know that on Fridays, we tend to take some chips off the table heading into the weekend because, again, the bond market can't make any moves during the weekend. So if all of a sudden someone invades another country or something crazy happens, we can't make any moves until the bond market opens. So they like to just hedge the bets just a little bit. The 10-year Treasury is down 3 basis points. Again, not a big move there. All right. So let's take a look here at some perspective charts. Right now, we are banging up against the ceiling of resistance after this week. Okay, so we've had a good run this week, but we haven't been able to break above this ceiling of resistance at the Fibonacci level of 101.671. Now, the last time that we broke above that, this is what we like to take a look at. When was the last time we were above that number? It was all the way back here on September the 13th before we were actually traveling above this number, and interest rates were probably in the mid fives, I would imagine, at that point. But take a look a little bit further back. Let's go 1 year back. Let's go 2 years back and see where we are. Okay, so let me get this just situated perfectly. Okay, so you can see when there was a steady market pretty much. I mean, ups and downs during the day, but not huge moves. This was when our interest rates were at those historic lows of the high twos, low threes on that 30-year fixed conventional home loan. This is when inflation began to set in and rear its head, and everyone started to say, we're going to have a problem. You can see that everything has been riding down consistently, but here's what we are excited about. In the last, when did this start? This started October of 2021. So a year ago now, 12 months ago, since then, generally our charts and trend lines have all been going down. But now we're finally starting to see the market turn. We're starting to see news of inflation subsiding, things that are upholding our thoughts that inflation is subsiding, and you're starting to see the 25-day moving average turn, the 50-day moving average turn, the 100-day moving average is flattening out, and even the 200-day, you see the trajectory begin to change. And this is how we're going to start turning the corner and start trying to head back up into these numbers that we were looking at, 6, 7, 8 months ago when interest rates were, again, probably in the low fives. So this is what we're kind of betting on. All right. So the other report we talked about here is the Personal Consumption Expenditure report. This report will be coming out, released on December the 23rd. We will definitely be talking about our strategy and what to expect later in the week as we go into next week. But where are we on our home loan interest rates here ending the week? All right, so after a consumer price index report and also announcements from the Federal Reserve of increasing the federal funds rate by 0.5%, we are sitting at 5.999 with an even bigger credit than yesterday of $1,526. Where are we if we want to pay a little bit? Well, 5.875 is costing $364. So once again, basically we're talking about a very well qualified 30-year fixed conventional home loan being at 5.875. At this point, guys, not just in the fives, not 5.999, not just barely scraping by, but we are pushing further into the fives at 5.875 with only $364 of cost. If you want to pay a little bit less than a point, 5.625. So that is good news. Take a quick look here. Let me do one more thing here. We got to modify this because we want to show our parameters for compliance purposes. So let's take a quick look at our FHA to make sure we know we're on our government loans here to finish up the week. And we will wrap it up. Okay, so FHA, 5.5% with a credit of $1,263. If you wanted to pay a point, I mean, just over a half a point, you're at 5.125. So just over a half of a point, you're at 5.125 on a 30-year fixed conventional home loan. 30-year fixed FHA home loan with 3.5% down. Much more palatable and much closer to those fours. So what we need to be doing is making sure that everyone knows this information. That is the point, is people do not think that we're at 5.125 with a half of a point on FHA today. They think we're in the high sixes, mid sevens, and maybe some mortgage companies are still offering that. We are not. There is no sense in going to a mortgage company right now that is at that high of interest rates. They're just charging too much, trying to make up for the losses that they've experienced because of the slowdown. So they're kind of taking that money from those that are buying. Anyhow, make sure you let me know your thoughts. Make sure you subscribe. Make sure you share, like, and let me know what you're thinking. Let me know if you like this information. I will get back to you again next week. Have a great weekend. We'll talk to you then.